5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to this episode of the Follow the Money podcast. Today's episode, number 503, entitled Calm in the Chaos. We're talking really about something that every investor eventually has to face, whether they're ready for it or not, and that's volatility, right? So over the last several days, we have seen a sharp pullback in silver, to a lesser extent also in gold. Also, Bitcoin has been dropping. Prices have been moving very fast. Obviously, that gets investors and speculators emotional. And for a lot of people, it was just plainly unsettling, right? And if you've been watching the charts, especially on the longer term time frames, you know that this kind of move, especially for silver and gold, wasn't really a surprise at all. In many ways, it was overdue. Maybe not to the extent. Maybe we didn't expect it to be as seismic as it was. And in the first segment, we're going to talk about why these sell-offs happen and what the charts were telling us ahead of time. Quite frankly, they were telling us quite a story before this sell-off. And then also why volatility is not something that you and I should fear, but something that we just need to basically understand. Then in segment 2, I'm going to be joined by a special guest, David Keller, CMT. He's the founder of MarketMisbehavior.com. We're going to talk about technical analysis and behavioral finance and why investor psychology matters so much to your success. And we'll wrap it all up with some concluding thoughts. With all that said, let's get started. Well, volatility has struck again, and here we are in the beginning of February 2026, and over the last several sessions, we've seen a sharp sell-off in precious metals. We've also seen a sell-off beginning to develop in big tech. We've also begun to see a sell-off emerging in Bitcoin. Bitcoin has also been coming down, so lots of volatility recently, right? And for a lot of people, this kind of move can be really unnerving when you see quickly falling prices and headlines that are, shouting, this is some sort of historic sell-off. And social media then begins to fill up with panic and predictions and finger pointing. And suddenly people start asking the wrong question. They'll say, what went wrong? Well, the better question to ask is basically what was already overbought, right? Because when you follow the charts, especially on the longer term time frames, the move in gold and silver in particular certainly didn't come out of nowhere. Precious metals, particularly gold and silver, platinum to a certain extent as well, were extremely overbought on the monthly charts and also on the weekly charts. And just last week, it was just a couple of days, it was on Wednesday, just before the Friday sell-off, where silver fell 30% in a single day. I mean, that is quite something, right? We also saw nearly 10% sell-off in gold on Friday. A lot of it came in response to the White House's announcement that Kevin Warsh was going to be replacing, or it would be the nominee to replace Jerome Powell. Now, the idea up until this point has been that Kevin Warsh, if you're not familiar with him, he's a Fed critic. He has also been hawkish in the past. He's softened on his tone this year, especially as he's been considered for the chief post over there at the Federal Reserve. The market seems to be thinking that he's going to come in and just start raising interest rates. But I'm not so sure. It's very difficult to imagine that President Trump would replace Jerome Powell with another clone of Jerome Powell who wants to raise rates or leave rates as they are, especially when the Trump administration has made it so clear that they want, quick rate cuts now. So regardless, the market was spooked, right? And we saw a hefty sell-off. But again, it didn't happen all in isolation. It wasn't just that event. We already had a lot of overbought, technical indicators telling us that it was time to at least take some profits. That's why I was mentioning last Wednesday, 2 days before the sell-off, I put out a note to our members letting them know that we were going to be taking some gains on our physical silver for the first time in years. It's been a long time since we've taken any money off the table in the silver market. But we just took a little bit off, trimmed a little bit of our holdings to raise cash because it was obviously getting very, very elevated, and we were definitely due for a pullback. Well, since that time, we've seen silver and gold rebound in a pretty impressive way. They're certainly not back at where they were, but they clawed back some of those losses. They've moved back up. Last time I checked, silver was near 90. Gold had reclaimed 5,000, at least briefly, before I went to record today's episode. But it's really important to understand that markets don't just go straight up. And for a lot of new folks, you get into an uptrend and you see it going up and you think, well, this is just going to keep going. And then you listen to social media or you listen to people who don't know a lot about the markets maybe, and you will get the idea that this is just going to continue on, that something new has happened. But in reality, markets don't move in straight lines. They breathe, they expand, and they contract, right? It's something very important to understand. And so volatility is not a flaw in the market, right? This is one of the things we try to teach here at Follow the Money, is that really volatility is the price of admission, right? If you want to be an investor in the equity markets, if you want to be an investor, especially in the crypto markets or in commodities, you better expect volatility, right? If you want upside, then you have to tolerate the drawdowns. If you want long-term gains, you have to sit through a lot of times, a lot of short-term discomfort. And there's really no version of investing where you get all the reward and none of the pain, right? That's very important a lot for newer investors and newer speculators as they come into the market. What gets people in trouble, I think, isn't the volatility itself. It's the expectations that they bring into the market, usually false expectations. Too many investors say they are long-term investors, but they react emotionally in the short term as if they're a day trader, right? They buy strength without a plan, and then they panic when price does what price always does. It goes up and it goes down. And this is where the charts really matter. This is where our follow the money, mantra, our follow the money philosophy really kicks into gear, where we teach our members how to read those charts. Many of our members were not caught off guard by the pullback in silver. Maybe the severity of the sell-off was unique, certainly, but the fact that it was due for a pullback was very obvious to anybody who could look at a chart, right? And by the way, when you're in an uptrend and you get a vicious pullback, that's not always bearish. In fact, they're usually healthy. They kind of reset the momentum. They kind of shake out the weak hands that are and some of the new speculators that come in that are just there to take advantage of the momentum. And they really give the market room to move again. But obviously, from a psychological level, it feels awful to see your, stocks or your ETFs or your digital assets or your commodities or whatever you're investing in, to see them going down just doesn't feel good. Obviously, you can start to feel fearful. Your mind can start telling you stories. Maybe the trend is over. Maybe it's different this time. Maybe I should just get out. And that's where behavioral finance really comes into play, right, in real time. And that's why it's so important to have rules. Having rules really makes a difference for investors who want to stay in this game for the long term. I mentioned that we are starting to see a sell-off also in tech, especially software stocks, as AI is starting to spook SaaS companies, software as a service. The fear is that generative AI and as it continues to emerge, it's going to really make many of these software companies obsolete, especially when you can just create, some sort of automation or use AI agents to simply create what it is that you want or to automate what you want. I think it's a bit over, the fear is a bit overblown, but nonetheless, we're seeing some pullbacks there. As I mentioned, Bitcoin as well coming down. We've seen Bitcoin now lose some of its key support, and it looks like we're moving into it looks like a pretty hefty bear market here for Bitcoin and Ether and many of these other digital assets, which, for those who like to dollar cost average, that's kind of what you want, especially if you have a long-term view. If you have a long-term investment thesis, when prices come down, it allows you to buy more with your DCA dollars, your dollar cost average dollars that you're using. But here's my point though: if you don't really decide how you're going to respond to volatility before it happens, the market usually will end up deciding for you in the moment. And the market is not kind to emotional decision making. One of the biggest mistakes people make is confusing volatility with some sort of inherent danger, right? Volatility is movement. Sometimes it's big movement. Danger is, when you're over leveraged or you're overexposed or you have poor position sizing. That's dangerous, right? But volatility itself, that's not dangerous. That's just part and parcel of investing. So if you're properly allocated, and if you're not chasing green candles, and if you're not just buying things at the very top, if you're not using leverage that you don't fully understand, then volatility is actually, again, just manageable. It's useful even. It creates opportunities. Corrections are where, you will get a strong uptrend that kind of refreshes itself. Again, you shake out those weak hands. So important. Pullbacks are where future gains are built. I tell you what, as a long-term investor over many years, I can tell you that it's in the bear markets where you make money, right? That's where you can accumulate. And being able to push the sell button when markets are overstretched, like we've been seeing, that's another really key lesson, right? Those who are able to stay calm while others are reacting out of emotion, boy, they can really walk away with a lot more out of this whole thing we call investing in the end. But of course, markets will always test your emotional discipline before they reward your patience. Every bull market does this. Every cycle does this. The question is not whether volatility is going to, rear its ugly head again, right? The question is whether you're going to be ready for it when it does, because calm in the chaos doesn't happen by accident. It happens because you train your mind and you prepare for what's ahead. And that really sets the stage perfectly for our next segment, where we're going to talk with David Keller about how market psychology and technical analysis intersect and why understanding your own behavior may be the most important edge you'll ever have in investing. That interview's on the other side of this quick break. Stay with me.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
Well, today I am very excited to welcome David Keller. David is a chartered market technician, and many of you know him as the former chief market strategist at stockcharts.com, where he helped thousands of investors understand market trends through disciplined technical analysis. Today, David is the president and chief strategist at Sierra Alpha Research and the founder of marketmisbehavior.com, which is a market research website that combines technical analysis and behavioral finance to deliver unique market insights. David and I recently connected at the Money Show in Florida. We hit it off right away, and I knew I wanted to have him on my show. David, thanks for being here.
No, good to see you again, Jerry. Thanks for having me on.
Absolutely. So I really want to introduce you and your work to our audience, because it's incredible how much overlap there really is in terms of research and in terms of focus on technical analysis. I love your behavioral finance emphasis. That's such a huge thing. The psychology behind trading and investing is, obviously very important, but sometimes underplayed. So before we get into some of that, How did you first get interested in the markets? Tell us how you got interested in the markets and technical analysis. Was there a moment where things really kind of clicked for you early on? Tell us the story.
Yeah, no, thanks, Jerry, for asking. I have the very traditional background of studying music and psychology as an undergrad, and then I ended up in the financial industry somehow. And somehow those two disciplines uniquely qualified me to be a good technical analyst, as far as I can tell. So the psychology makes a ton of sense. And the reason why I've always been drawn to the behavioral aspects of investing is because I studied all about how people think and how they behave and how they interact with others. And that is, I would argue, what you're doing as a market analyst is you're analyzing the herd, you're analyzing, what investors are thinking, and you're tracking their emotional state, which usually fuels their buy and sell decisions. The music thing's a little more of a stretch, but here's what I would tell you. I was actually studying orchestral conducting. So I was studying, leading an orchestra. And if you've ever done that, or if you've seen it done, you have like 100 musicians on a stage, and then you glance down at an orchestral score, and you immediately have to visually detect patterns. You have to figure out who's playing together and who's like where there's tension, where there's release. And then based on your understanding of market history, you kind of naturally anticipate what's going to come next based on the musical period you're in and all of that. And so when I first saw a chart with a bunch of technical indicators, it was like I'd been training for that somehow by analyzing music. So it's the same thing. I'm looking at patterns. I'm looking for divergences. I'm looking for tension and release in terms of momentum shifts. And then based on your knowledge of market history and where we're at in the cycle, you start to anticipate, all right, given this setup, this is what's most likely going to happen next. And so the combination of those two, the moment I learned about technical analysis, it just seems like I was meant to do it. And I haven't looked back. That was 26 years ago when I first learned about it.
That is very unique. I didn't realize that. And you also, so is music still an outlet for you? Do you still play piano? Do you play guitar? What do you play?
Yeah, so I studied trumpet and voice in college. I've played off and on, but I've sung a lot more often. So I actually sing with the Seattle Symphony Chorale. We're based in the Seattle area. So I sing with the orchestra, which is a ton of fun. And my wife's a concert pianist. We met at music school at Ohio State. So pretty important to both of us.
That's great. That's beautiful.
Yeah.
Okay, so you also, as I mentioned at the outset, you're a chartered market technician, right? This is the CMT. Talk to us about what that is. Many people might see that, that they might see that that acronym right there after people's name. How did pursuing that change the way you approach the markets compared to maybe how you thought about it earlier in your career?
For sure. The chartered market technician, if anyone's familiar with the CFA, the Chartered Financial Analyst, it's sort of like a CFA for technical analysis. So this was created in the 1980s, the early 1980s, as a way of training professional technical analysts, people that were publishing on Wall Street, to have consistent standards of the body of knowledge, consistent understanding of technical tools and concepts, and then ethical standards, which everyone that got the designation agreed to abide by. And I think that in this day and age, I feel like that structured training, but also the ethical standards, I think go a long way in an industry which is not necessarily known for consistent following of ethical standards. I think that's pretty important. But for me, the reason why I started taking the CMT, this was in the mid-2000s, I was learning about technical analysis, but I would say my results were mixed. There were some things I tended to do very well, moments when I felt like everything made sense. And then there would be other moments where just everything unwound and I feel like I had no idea what was going on. So it was what I learned, a very amateurish, very unstructured, undisciplined way of following market trends. The CMT is a 3-part exam series that takes you all through what technical analysis is, how the indicators are derived and how they relate to one another, and then how you use them to communicate and understand the trends, but also be able to talk about them in a meaningful way. And so I went into the CMT program with a very undisciplined, unstructured process of analyzing charts, and I came out with a really good checklist of these are the things I'm going to follow every time I look at a chart. And from that moment on, I learned more about consistency and discipline and less about just, rolling the dice and seeing if the chart went in my favor. So I came out a much more disciplined analyst, and that from then on has been has led to a lot of really good things built on that discipline and that structured approach to analyzing the markets.
Okay, so and I really like the combination of the technical analysis and then also the behavioral finance, which I heard come through whenever we were at the Money Show, and I heard one of your speeches there.
Yeah.
And I really liked how you combine them. So maybe we can talk about that a bit. So as you've grown as an investor and you've learned and you have an understanding of investor behavior, let's just talk about you personally. Like, what have you personally had to unlearn with regards to the markets? How have you grown? Like, what did you have to unlearn? What was some of the tough things you had to unlearn?
Oh, that's such a great question, Jerry. And I mean, it's funny. I feel like for most investors, you go through that natural process where you get overconfident, probably a number of times during your career, but particularly early on, and you have like a trade or two that go really, really well. And I remember I started in the industry in 2000, so like 2001, 2002 was when I was learning about how to analyze the markets. I'm talking about a crazy time to try to get your head around that kind of thing, but I learned a ton. It was all about risk management. And I remember buying stocks like XM Satellite Radio when it was just kind of coming out. I remember buying Royal Caribbean Cruise Lines after it, it felt like no one was ever going to cruise again. And they're like, well, hold on a second. And the charts started to improve. And so there were a couple trades where I felt like this is amazing. And then I became incredibly overconfident. And I would say the one I remember in particular was holding on to a stock way too long. I bought it at like 10. It went to 40. And then I just sat there holding on to it as it went to 30 and 20 and like all the way back to my entry point. It's like, the casino story that every, chronic gambler probably has, right? Where you give it all back to the house. And for me, that helped me to recognize, okay, I need to stop thinking about market analysis and technical analysis as a way of like finding the next home run. And it's not about swinging for the fences every time. It's about when you're right, staying right. And when you're wrong, not being wrong too long. And that once I sort of made that mental switch of recognizing that following the trends as long as possible is going to help me continue to compound gains, and getting out, don't let your, small losses become large losses. Don't let your losing trades become your investments. I had a couple examples of where that just happened. And I would double down on names that were already in downtrends. And so I think unlearning that I was a rock star stock picker and sort of learning that you're going to be wrong. And it's not about being right all the time. It's about admitting when you're wrong. And that is it. And that, I think, led me down a behavioral path of realizing I was the problem, right? It wasn't the market. It wasn't my tools. It was what was happening between my ears. And so in my own investing, I really thought about how I could avoid making really bonehead decisions. And when I worked at Fidelity Investments, I would do the same thing with diversified portfolio managers, helping them get out of their own way and add more discipline. And so that has really helped me shape how I think about the markets and talk about the markets today.
When I was on your podcast not too long ago, we had also talked about meditation just a little bit. And that's such a huge thing for me, in terms of keeping peace of mind when you're dealing with the markets. They can be chaotic. You have the ego that's always rising up, as you're talking about there. So peace of mind is so incredibly important too, isn't it? If you're getting all tangled up and you're feeling up in knots and your portfolio is making you nervous, this is the stuff you're talking about, right? This is the stuff you address.
Mindset is a huge issue. And Jerry, I would say in 2026, the good news and also the bad news is that traders have access to more information than ever, right? So you've got a fire hose of information. You have instant gratification with flickering ticks on whatever platform you're watching. We've got news streams coming in. So we have access to more information, which on the surface seems very, very good. But I think that also just, creates so many opportunities for you to, not be disciplined and to overreact to short-term data. So what I always try to remind people is, make short-term decisions with short-term data, make long-term decisions with long-term data. And the problem is we are faced with an endless stream of short-term information, right? An instant headline, one moment. And as we know in this day and age, things can change dramatically. So I think the way you get through that and the way that you have a better mental state through it, number one is taking care of your own mind. And that's through prayer, meditation, those mindful moments that help you to disconnect from, what you're doing with the moment every day and really reflecting on what you're actually doing it for. I think that's important. Journaling is another thing that I do to make sure that I just connect with, what are my intentions today, and be more thoughtful and deliberate with how you spend your time, as opposed to just doom scrolling with financial data, which is, I feel like, what a lot of investors do in these days. And then as you go on, I think it's also taking care of yourself, through the course of the trading day, taking time and making time to reflect on good decisions that went well, but even more learning from mistakes that you made. And in the, sort of stream of consciousness way that a lot of us live these days, we kind of always move on to the next trade, the next thing. And I found that the most successful investors I work with really make time to go back and say, okay, that trade didn't go well. Like, what happened? What did we miss? What can we learn? What can we do better? What can we do different? That's where I've seen investors really improve their process over time. And I think everyone can do it. They just have to make time for it and really focus on the mental game of trading.
Yeah, those are good insights. I think about the news cycle, the 24/7 news cycle that you brought up, and it is such a temptation. I remember when I first started trading that, I wanted to have all of the business channels on. I felt like that's what a trader did. You're supposed to pay attention to every single press release that comes out. So what's your approach to news today? In other words, with all of your insights on behavioral finance, you've learned a lot about yourself, of course, over time. You don't necessarily have to tell everybody what they should do, but what's your approach to news? How do you digest it? How much do you focus upon the news? How little do you focus on the news?
It's such a challenging balance, Jerry. And I learned a similar lesson, earlier in my career. And I remember going to a trading floor and they had like CNBC or Bloomberg or one of those channels on, but they had it muted. And I figured, same thing. I figured they would be like glued to the screen and looking at everything. And they're like, that just gets in the way of what I'm trying to do. What I'm trying to do is right here. And this is, and I realized like that was something happening over there, but like this in front of me is what's most important. So for me, I think the temptation and the danger, particularly with mobile devices, is that you're always glued to the news. Like something is always going to happen. And unfortunately, we have a lot of companies who are trying to get you to pay attention to every little thing. So they try to sensational. Everything has like the big, bold, huge 36-point font headlines to try to draw you in, right? Because that's their job, is to try to get you to watch it. My job is to understand the news, but to put it into context. So for me, I actually try to have focused times on the day. Once first thing in the morning, which is like after and I'll tell you, the order is important. My order of operations is the first thing I do is look at a long-term weekly chart of the S&P 500. So I look at the last like 5 to 7 years of data. So before I know what headline is happening, it's like, let me just connect with the long-term trends that I'm trying to understand. Then I go through a series of other charts that help me understand, okay, what are the conditions, and not just today, but over time, right? What are the conditions over the last month, over the last 6 months? Then I look at the news to see what happened today. And I think of the news flow as incremental new data points that add to that picture I've already started to create. And a lot of people, I think, flip that. They look at what's happening at this moment. They look at who reported earnings today. They look at their brokerage account, and then you're immediately drawn into some short-term something. You start long-term, and then that anchors you to that way of thinking. So, for me, that's been helpful. And then just having a couple times during the day, I try to do the same with email, not just checking it all the time, but force myself. I actually set an alarm like, okay, 11:30, check my email. You got a little window, do it, and then go on to do other things. And those couple of changes really help me be more, I think, intentional with how I spent my time. And I think that's a challenge in the modern age here.
Oh, so much so. So much so. It's so enticing just to scroll, and, get caught up in it. Well, what's interesting about the markets too, especially from a psychological viewpoint, is that it's just composed of market participants. So the market is really kind of a mirror of human behavior, if you will. So when you look at the current market environment, what does it say to you about us psychologically right now? What are you gathering from the current market environment?
Yes. What a great question. It's interesting. I mean, I would say obviously there's been a lot of changes in terms of the structure of the market. I mean, we've gone through so many different phases just in the last like 12 to 18 months. And I think 2025 had a number of different periods. And for me, the charts are a way of visually understanding and appreciating like what the mindset of the investors really is, what that mindset, that collective mindset is. And I would say like in mid 2025, we had this nice, long, low volatility uptrend. The leadership was fairly focused into AI and AI related names, very tech heavy leadership, and everything else was kind of lagging, but generally kind of doing okay. And then in the fourth quarter, that all changed, right? The S&P 500 went from making new highs to failing to get much above 6,900. So it's really been more sideways over the last quarter. The momentum, which was very, very strong, like in July, August, not to get too deep into technical indicators, but measures of momentum like RSI became overbought, which implies, excessive strength to the upside. If you look in the fourth quarter, indicators like that are a lot lower. So, momentum has waned. The strength of the trend has changed, and it's felt much more like a consolidation phase than an accumulation phase or an appreciation in price. So I think that shift mirrors uncertainty, even though the VIX, right, a great measure of volatility remains, incredibly low, given I feel like life volatility, it feels like many of us are experiencing right now. And news volatility, market volatility has remained low, but it really represents indecision, right? The market is not at this moment in an aggressive uptrend. It's not really in a risk-off move like we saw in like March, April of 2025. It's somewhere in the middle. So it really is sort of a treading water kind of environment. And in some cases, that's helpful because at some point, that will shift. And I think this is one of those times, there's probably not a bad time to look at charts, but this one for me is a really important time because I think at some point we will see the initiation of a new trend. And I don't know at this point whether that's a new uptrend and maybe earnings provide that upside, or if it's more of a risk-off move because of uncertainty and something with the Fed or geopolitical issues. But I know the charts are going to help us understand when that character has changed, and I think that's going to be important to watch for.
Yeah, let's drill down into that just for a minute because that's very interesting. So, how do you, with your experience, how do you personally distinguish between a healthy uptrend, as you were referring to, and maybe a market that's beginning to become fragile? Many of us are familiar with the stage analysis where you can kind of see where the market's beginning to top. What metrics do you look at? You mentioned RSI. Is that an important one to you to determine that?
I would say there's three things I would look at, Jerry. Number one is trend. Number two is momentum, which includes RSI, as you mentioned. The third would be leadership and just the nature of what types of companies are leading or lagging. And quickly, one by one, the trend, it to me is very simple. I have a 9-year-old son named Henry, and my question is always, would Henry say this chart is going up or down? And he's pretty good at looking at a chart and quickly assess. That's how simple it has to be. But so often we just neglect that very basic assessment of, is this a stock or an ETF going up or down, right? We get into many other cute and complicated things instead of just saying simple. So I would say, number one, the trend has stalled out, right? In that the S&P was making consistent new highs and really hasn't made a new high since October, November. It's the last time we really made an aggressive new high. Since then, it's been more retesting that upper end of that range. The momentum has shifted quite a bit, and RSI is an indicator I would use. The ADX line is a average directional movement. That's an indicator also created by Wells Wilder. Different indicators, but both measuring sort of the strength of the trend as measured by momentum or different characteristics. In a healthy bull market, the range of an indicator like RSI all kind of drifts higher. So the market will become overbought as buyers are aggressive. The market will pull back, but it won't pull back much in terms of momentum. In more of a consolidation phase, the momentum remains relatively neutral because buyers and sellers are generally even. And so we've seen that momentum come down to more of like a neutral footing as opposed to being more in the bullish range. And that was a change in the fourth quarter as well. And then the third one is leadership. And I think there's been a big shift from growth to value. And here in January, I feel like one day to the next, that's flipping around very quickly. But generally, we've seen a rotation away from some of the technology names, even though some are still making new highs, like a Micron. There are many others that are not near their new highs anymore. Whereas if you look at industrials, materials, obviously gold and mining stocks, but specialty chemicals names, for example, doing quite well. Other value sectors, even like consumer staples, you have stocks like Target that are starting to break out. So the leadership is now starting to shift. and in a lot of ways into some of those late cycle sectors like materials, like energy, which has been, an ugly place for so long, starting to improve. So these are things that generally tell me this is not a healthy growth-led bull market. This is something different. And I think for me, using charts to really identify leadership is a huge advantage from just looking at the index itself and drawing broad conclusions there.
I'm speaking with David Keller, CMT. He's the founder of marketmisbehavior.com. David, I appreciate your time. We're in our final moments here. Just a couple of more questions. What I do want to ask is if you could give one piece of advice to someone out there who's trying to become more consistent in the markets, what would that be? What would that be?
Ooh, just one thing, huh? So many things come to mind. If you want to be more consistent, right? I mean, I think it for me, it comes down to your routines. And I learned a ton from working, managing professional analysts at Fidelity. The most successful analysts on my team, I ran the technical research team there for a number of years, and my most successful analysts, they weren't, doing innovative, crazy new ways of thinking about things. They were doing the same thing every morning at 7:15. They'd have the cup of coffee, they'd have the pile of charts, and they'd go through them. And 3 mornings later, I'd find them at the same table, with the same pile, and same thing. And so I realized what they were doing was not overly complicated. It was just so consistent that it was impossible for them to miss changes. And I find a lot of times when investors and when traders struggle, it's not because their crystal ball isn't working right. It's because they're just not, sticking to routines. It's a consistency problem. It's not a prediction problem. So the way that you don't miss the next thing is by reviewing those things regularly, and that's how you detect changes. So for me, I would write down with a pen and paper, what do you do every morning to prepare for the day? Every week, what do you do to think about what you learned and to prepare for the next week? Once a month or once a quarter, what do you do to really step back and reflect on what happened and what went well and what didn't? And if you do that consistently, not just once, but consistently, that's where your trades start to get better. That's where your decision-making tends to become crisper because you've written down and documented, and then it's less unstructured, it's more structured. And I think that's where people need to generally improve on.
That's such good advice because it is true. I mean, I have my own routine, daily routine. I do a Friday routine every Friday.
Yeah.
And every single, just to kind of look at the market, see what happened during the week. And it's true. And this may sound strange. I'm sure you know what I'm talking about. You might have a better word for it, but I almost feel like you almost get into the rhythm of the market. And then it's not that I am able to detect which way it's going to go next, but it may not surprise you that it does that. So in other words, you're able to kind of ride the market and you feel it almost. It's hard to describe. But when you get that consistent routine, you almost just kind of sense things that are happening and you kind of see them play out. So it gives you a lot more confidence perhaps too, which is key.
100%. And then once you have a good sense of the rhythm of a market, I think is a great way of describing it. Then when that rhythm changes, it becomes more obvious, right? It's not just about your routine today and what are my conclusions today. It's reflecting on what's different. And then you're not focusing on relearning everything. It's just like, okay, all this was the same, but this over here was a little bit different. What's happening? What's new? What does that mean? And that's when you can start to understand the interrelationships of this complex machinery of the markets. It's through the routines, as you mentioned. I think that's a great way of describing it.
David, I really appreciate your time today. Where can people follow you? Where can they find you online and get connected with what you're doing?
No, thanks so much, Jerry. You did an awesome job with the show. I'm thankful to be a part of it. Thanks for the invite.
Thank you.
My website's marketmisbehavior.com. I do a market recap show. I do a podcast that I'm very thankful that you came on that podcast as well, as that was a great conversation. So people can find me and follow my work just there.
Marketmisbehavior.com. David Keller, CMT. Great to have you, my friend. Good to see you.
Thanks, Jerry. Good to see you too.
All right, friends, welcome back to the final moments of today's episode. And I hope you enjoyed that interview with David Keller. I really appreciate David's work and really enjoyed meeting him, as I mentioned, down at the Money Show when we were there together in Florida. last year. But let me just say this. I want to leave you with some of these thoughts. This recent sell-off we've seen in precious metals, the ongoing sell-off we're seeing in technology and especially software stocks and even the digital asset space, this sell-off is not breaking anything, right? It reminds us of something we already knew, but we often forget. And that is that volatility is not a flaw in the markets. It is literally the cost of participation. You want to be involved in the markets, you want to earn the big gains over time, you've got to go through these tough times sometimes, right? So when assets run really hard and then they get technically stretched, pullbacks are not just normal, they're healthy. The charts were warning us, right? We were seeing this on the charts, especially with silver and gold. Sentiment was getting crowded, prices finally corrected, and the emotional reaction told us more about investors than it did about the assets themselves. And if you want to see the emotional reaction to the latest sell-off, just go on social media, you'll see. There was a lot of fear, right? And that's why discipline matters. That's why having a process matters. That's why having rules matters, and why understanding both technicals and human behavior is such a powerful edge for investors and traders. Again, markets do not move in straight lines, right? The goal is not to avoid volatility. The goal is to remain steady despite the volatility. And that brings me to today's final word. In his book, Meditations, Marcus Aurelius once wrote, quote, "You have power over your mind, not outside events. Realize this and you will find strength." The truth is that you can really rest in the knowledge that you don't control everything. You can't control the markets. You cannot control the direction the markets are going to go today, tomorrow. None of that is in your control. The markets are going to move the way they're going to move. The headlines are going to come out just the way they're going to come out. And fear is going to arise in the everyday investor. But your edge as an investor is not about controlling any of those things. It's never been about that, and it's never been about predicting where things are going to go. It's always been about controlling your response and your reaction when uncertainty shows up. You have power over your mind, but you do not control things outside of yourself, right? That is such an important lesson to learn, and that is just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.